Question 1. A broker-dealer must calculate its net capital on a weekly basis, b. monthly basis, c. quarterly basis, d. daily basis. Answer: D. Daily basis. Broker-dealers are required to compute their net capital position daily to ensure continuous compliance with the SEC's Net Capital Rule, SEA Rule 15C3-1. This daily calculation is crucial for monitoring the firm's financial solvency and its ability to meet its obligations to customers and creditors at all times. Although focus reports are filed monthly or quarterly, the underlying net capital calculation must be performed every business day. Maintaining a daily snapshot of the firm's financial health is fundamental to risk management for a broker-dealer. Question 2. Under SEC Rule 15C3-3, a broker-dealer must determine the amount of funds segregated in its special reserve bank account for the exclusive benefit of customers based on a formula computed a. monthly, or weekly if aggregate indebtedness exceeds 800% of net capital. B. weekly, or daily if aggregate indebtedness exceeds 800% of net capital. C. monthly, or daily if net capital falls below 120% of the minimum requirement. D. weekly, or monthly if customer debit balances are less than customer credit balances. Answer: B. weekly, or daily if aggregate indebtedness exceeds 800% of net capital. The Customer Protection Rule, SEA Rule 15C3-3, mandates that broker-dealers perform a reserve formula computation at least weekly to determine the funds needed in the special reserve bank account for the exclusive benefit of customers. However, if a firm's aggregate indebtedness exceeds 800% of its net capital for 2 consecutive business days, the computation must be performed daily until the condition is no longer met. This stricter daily requirement ensures heightened protection for customer funds during periods of increased financial risk for the firm. Regularly reviewing this computation is a key responsibility for financial operations professionals. Question 3. Which of the following is typically deducted from a broker-dealer's net worth to arrive at tentative net capital? A. Accounts payable to non-customers. B. Subordinated loans. C. Securities held for investment purposes. D. Non-allowable assets. Answer: D. Non-allowable assets. To compute a broker-dealer's tentative net capital, non-allowable assets are typically deducted from the firm's net worth. Non-allowable assets include items that cannot be readily converted to cash or are not liquid enough to be relied upon for meeting a firm's financial obligations, such as fixed assets, prepaid expenses, and exchange memberships. This deduction ensures that net capital reflects only assets that are truly available to protect customers and creditors, rather than assets that may be difficult to liquidate. Understanding what constitutes a non-allowable asset is crucial for accurate net capital calculations. Question 4. A broker-dealer's annual audit report, including the statement of financial condition, must be filed with the SEC and FINRA within a. 60 calendar days after the date of the financial statements. B. 90 calendar days after the date of the financial statements. C. 120 calendar days after the date of the financial statements. D. 180 calendar days after the date of the financial statements. Answer: B. 90 calendar days after the date of the financial statements. SEC Rule 17a-5 requires broker-dealers to file their annual audited financial statements with the SEC and FINRA within 90 calendar days of the firm's fiscal year-end. This filing provides regulators with a comprehensive overview of the firm's financial health as verified by an independent public accountant. Adhering to this deadline is a critical compliance obligation for all broker-dealers. Timely and accurate annual audits are essential for regulatory oversight. Question 5. The Securities Investor Protection Corporation, SIPC, protects customer accounts up to a. $250,000 for cash and securities, with a $100,000 limit for cash. B. $500,000 for cash and securities, with a $250,000 limit for cash. C. $1 million for cash and securities, with a $500,000 limit for cash. D. No limit, as SIPC covers all customer losses in a broker-dealer insolvency. Answer: B. $500,000 for cash and securities, with a $250,000 limit for cash. SIPC provides protection for customer accounts against broker-dealer insolvency, covering up to $500,000 in total, which includes a maximum of $250,000 for cash. This protection applies to each separate customer, not per account, meaning if a customer has multiple accounts, e.g., individual, joint, IRA, they are treated separately for coverage purposes. SIPC restores customer securities and cash that are missing due to the firm's failure, not losses due to market fluctuations. It is important to remember that SIPC is not an insurance policy against investment losses. Question 6. A broker-dealer must file a suspicious activity report, SAR, within how many days after becoming aware of a suspicious transaction? A. 10 calendar days. B. 20 calendar days. C. 30 calendar days. D. 60 calendar days. Answer: C. 30 calendar days. Under the Bank Secrecy Act, broker-dealers are required to file a suspicious activity report, SAR, with the Financial Crimes Enforcement Network, FINCEN, within 30 calendar days of becoming aware of a suspicious transaction. This report is a crucial component of anti-money laundering, AML, efforts, designed to alert authorities to potential illicit financial activities. Firms must have robust systems in place to detect and report such activities promptly, as failure to do so can result in significant penalties. Staying vigilant for red flags of money laundering is essential for compliance. Question 7. According to FINRA Rule 4511, a broker-dealer must generally retain most business records for a period of A. 3 years. B. 5 years. C. 6 years. D. 10 years. Answer: C. 6 years. FINRA Rule 4511, which outlines general record-keeping requirements, mandates that most business records of a broker-dealer must be preserved for a period of 6 years. This includes important documents like blotters, ledgers, and customer account records. The 6-year retention period helps ensure that regulators have sufficient access to historical data for oversight and examination purposes. Always maintain an organized and easily accessible record-keeping system to comply with these rules. Question 8. Which of the following is considered readily convertible into cash for net capital purposes? A. Real estate owned by the broker-dealer. B. Furniture and office equipment. C. Marketable securities subject to appropriate haircuts. D. Exchange memberships not transferable. Answer: C. Marketable securities subject to appropriate haircuts. For net capital purposes, assets considered readily convertible into cash are those that can be sold quickly at or near their market value. Marketable securities, even with their required haircuts, deductions for potential market risk, fit this description because they are actively traded and can be liquidated promptly. In contrast, real estate, furniture, and non-transferable exchange memberships are generally deemed non-allowable assets due to their illiquidity. The concept of readily convertible is central to ensuring a firm's net capital accurately reflects its liquid financial strength. Question 9. A broker-dealer must file an early warning notification with the SEC and FINRA if its net capital falls below A. 120% of its minimum net capital requirement. B. 150% of its minimum net capital requirement. C. 200% of its minimum net capital requirement. D. 500% of its minimum net capital requirement. Answer: A. 120% of its minimum net capital requirement. Under SEC Rule 17a-11, a broker-dealer is required to file an early warning notification with its designated examining authority, DEA, and the SEC if its net capital falls below 120% of its minimum net capital requirement. This rule is designed to provide regulators with advance notice of potential financial difficulties, allowing them to intervene before a firm's financial condition deteriorates further. Such notifications trigger heightened scrutiny and may lead to restrictions on the firm's operations, underscoring the importance of constant net capital monitoring. Question 10. Which of the following would generally be classified as an allowable asset for net capital purposes? A. An unsecured customer debit balance outstanding for more than 7 business days. B. Prepaid expenses. C. Fully paid for securities held in the firm's trading account, subject to haircuts. D. An outstanding loan to an associated person. Answer: C. Fully paid for securities held in the firm's trading account, subject to haircuts. Fully paid for securities held in the firm's trading account are generally classified as allowable assets for net capital purposes, though they are subject to specific haircut deductions to account for market risk. An unsecured customer debit balance outstanding for more than 7 business days, prepaid expenses, and outstanding loans to associated persons are typically considered non-allowable assets. This distinction ensures that only liquid assets, discounted for potential volatility, are counted towards a broker-dealer's regulatory capital. Always differentiate between allowable and non-allowable assets when computing net capital. Question 11. What is the primary purpose of a subordinated loan in the context of a broker-dealer's capital? A. To provide working capital for daily operations. B. To increase the firm's aggregate indebtedness. C. To be included as part of the firm's net capital for regulatory purposes. D. To secure funding for speculative proprietary trading. Answer: C. To be included as part of the firm's net capital for regulatory purposes. The primary purpose of a properly executed subordinated loan for a broker-dealer is to be included as part of the firm's net capital for regulatory purposes. A subordinated loan is a specific type of debt that ranks below all other unsecured creditors in the event of liquidation, making it essentially risk capital from a regulatory perspective. This enhances the firm's capital base, allowing it to meet higher net capital requirements. Such loans must conform to specific SEC rules, e.g., SEA Rule 15C3-1D, regarding maturity and non-withdrawal terms. Question 12. Free credit balances in customer accounts must be treated by a broker-dealer as A. Firm capital. B. Subordinated liabilities. C. Customer liabilities. D. Equity investments. Answer: C. Customer liabilities. Free credit balances represent cash held by a broker-dealer that is owed to customers and must be treated as customer liabilities on the firm's balance sheet. These funds are readily withdrawable by the customer upon demand and must be segregated in the Special Reserve Bank account for the exclusive benefit of customers under SEA Rule 15C3-3. Proper handling and segregation of free credit balances are crucial for customer protection and regulatory compliance. Always remember that free credit balances belong to the customer, not the firm. Question 13. Which of the following types of records must generally be maintained in an easily accessible place for the first 2 years of their retention period? A. All records for 3 years. B. All records for 6 years. C. Records required by SEA Rule 17A-3 and 17A-4. D. Only customer account statements. Answer: C. Records required by SEA Rule 17A-3 and 17A-4. SEC Rules 17A-3 and 17A-4 specify that certain critical broker-dealer records, such as blotters, ledgers, and customer account records, must be kept in an easily accessible place for the first 2 years of their required retention period. For most records, this means the first 2 years of a 6-year retention period. This easily accessible requirement facilitates prompt regulatory examinations and investigations. Ensuring immediate access to current and recently archived records is a key operational responsibility. Question 14. What is the typical frequency for a broker-dealer to file a focus report Part 2 or IIA? A. Annually. B. Quarterly. C. Monthly. D. Monthly or quarterly, depending on the firm's financial status. Answer: D. Monthly or quarterly, depending on the firm's financial status. Broker-dealers typically file Focus Report Part 2 or IIA, Financial and Operational Combined Uniform Single, either monthly or quarterly, depending on their level of business activity and capital. Firms with higher aggregate indebtedness or lower capital generally file monthly, while smaller firms or those maintaining higher capital levels may be permitted to file quarterly. This periodic reporting keeps regulators informed of the firm's financial condition and operational results. Understanding your firm's filing frequency is a fundamental aspect of financial operations. Question 15. A broker-dealer's business continuity plan, BCP, is primarily designed to A. Increase the firm's annual revenue. B. Ensure the firm's ability to resume operations promptly after a significant business disruption. C. Dictate employee compensation and benefits. D. Outline the firm's marketing and sales strategies. Answer: B. Ensure the firm's ability to resume operations promptly after a significant business disruption. A business continuity plan, BCP, is primarily designed to ensure that a broker-dealer can promptly recover and resume its critical business operations after a significant disruption, such as a natural disaster, technological failure, or other emergency. The BCP must address how the firm will communicate with customers and regulators, maintain access to customer funds and securities, and ensure continued operations. Developing, testing, and updating a robust BCP is crucial for risk management and regulatory compliance. Question 16. What is the purpose of haircuts applied to securities positions in a net capital computation? A. To account for the potential for market price fluctuations. B. To reduce the firm's tax liability. C. To increase the firm's overall net capital. D. To cover administrative expenses related to holding securities. Answer: A. To account for the potential for market price fluctuations. Haircuts are percentage deductions applied to the market value of a broker-dealer's securities positions when calculating net capital. The purpose of these haircuts is to account for the potential for adverse market price fluctuations that could occur before the securities could be liquidated. This conservative valuation ensures that the firm's net capital truly reflects its available liquid resources, even if market values decline. Always remember that haircuts are a risk management tool to protect against market volatility. Question 17. Which rule requires broker-dealers to obtain an independent public accountant's report on its internal controls? A. SEA Rule 15C3-1, Net Capital Rule. B. SEA Rule 15C3-3, Customer Protection Rule. C. SEA Rule 17A-5, Reports to be made by certain brokers and dealers. D. FINRA Rule 3110, Supervision. Answer: C. SEA Rule 17A-5, Reports to be made by certain brokers and dealers. SEA Rule 17A-5 requires broker-dealers to file an annual audit report which includes a report from an independent public accountant on the firm's internal controls. This independent assessment provides assurance to regulators that the firm has adequate controls in place to protect customer assets and maintain accurate financial records. A strong system of internal controls is critical for safeguarding a firm's integrity and preventing financial misconduct. Question 18. An introducing broker-dealer that clears its transactions through another firm is generally exempt from the requirements of SEC Rule 15C3-3, Customer Protection Rule, if A. It does not hold customer funds or securities. B. Its net capital exceeds $100,000. C. It only deals with institutional clients. D. It is a member of FINRA. Answer: A. It does not hold customer funds or securities. An introducing broker-dealer that clears its transactions on a fully disclosed basis through a clearing firm is generally exempt from the requirements of SEC Rule 15c3-3, the Customer Protection Rule, if it does not hold customer funds or securities. In such arrangements, the clearing firm takes on the responsibility for maintaining possession or control of customer assets and computing the reserve requirement. This exemption simplifies compliance for introducing firms by placing the full burden of customer asset protection on the clearing broker. Question 19. If a broker-dealer incurs a material inadequacy in its accounting system or internal controls, it must notify the SEC and its DEA, designated examining authority, within A. 24 hours, B. 48 hours, C. 5 business days, D. 10 business days. Answer: A. 24 hours. If a broker-dealer discovers a material inadequacy in its accounting system, internal controls, or procedures for safeguarding securities, it must provide immediate written notice to the SEC and its DEA within 24 hours. This swift notification allows regulators to take prompt action to address potential risks to customer funds and securities. A material inadequacy signifies a significant deficiency that could jeopardize the firm's financial integrity or its ability to comply with regulations. Question 20. When a broker-dealer liquidates and returns funds to customers, which type of funds are returned first? A. Subordinated loan proceeds. B. Proceeds from the sale of firm inventory. C. Customer funds held in the special reserve bank account. D. Funds from the general operating account. Answer: C. Customer funds held in the special reserve bank account. When a broker-dealer liquidates, customer funds held in the special reserve bank account for the exclusive benefit of customers, under SEA Rule 15c3-3, are prioritized and returned to customers first. These funds are segregated specifically to protect customer assets and are not available to general creditors of the firm. This segregation is a cornerstone of investor protection, ensuring that customer money is insulated from the firm's own financial difficulties. Question 21. Which of the following best describes the aggregate indebtedness calculation for net capital purposes? A. Total liabilities of the broker-dealer. B. Liabilities of the broker-dealer that are not specifically exempted from the calculation. C. All liabilities to customers, including free credit balances. D. The sum of all outstanding loans to the broker-dealer. Answer: B. Liabilities of the broker-dealer that are not specifically exempted from the calculation. Aggregate indebtedness, AI, for net capital purposes includes most liabilities of a broker-dealer, but specifically excludes certain items that are considered non-AI or are otherwise part of the firm's capital, such as properly executed subordinated loans and deferred tax liabilities. The AI calculation is crucial because a firm's net capital requirement is often based on its AI, e.g., 6 2/3% of AI for new firms, or 8% of AI for established firms. Understanding what constitutes AI is essential for determining a firm's minimum capital requirement. Question 22. What is the primary purpose of the Customer Identification Program, CIP, required under the Bank Secrecy Act? A. To ensure customers receive personalized investment advice. B. To verify the identity of customers opening accounts. C. To track customer trading activity for market abuse. D. To assess customer suitability for certain products. Answer: B. To verify the identity of customers opening accounts. The primary purpose of a Customer Identification Program, CIP, under the Bank Secrecy Act is to verify the identity of customers opening new accounts at a financial institution, including broker-dealers. This program is a critical component of anti-money laundering (AML) efforts, designed to prevent terrorists and criminals from using the financial system to launder money or finance illegal activities. Accurate customer identification is the first line of defense against illicit financial flows. Question 23. A broker-dealer must maintain a general ledger that reflects all assets, liabilities, income, and expense accounts, and is posted A. Monthly, B. Weekly, C. Daily, D. Quarterly. Answer: C. Daily. A broker-dealer must maintain a general ledger that is posted daily to accurately reflect all assets, liabilities, income, and expense accounts. This daily posting ensures that the firm's financial records are current and that management has up-to-date information for monitoring its financial condition, including net capital. Maintaining a current and accurate general ledger is foundational to sound financial management and regulatory compliance. Question 24. What are broker-dealers required to do with excess margin securities, as per SEA Rule 15C3-3? A. They must be held in the firm's proprietary account. B. They must be promptly returned to the customer upon demand. C. They must be promptly segregated from firm and customer securities. D. They may be rehypothecated to secure firm borrowings without restriction. Answer: C. They must be promptly segregated from firm and customer securities. Under SEA Rule 15C3-3, broker-dealers are required to promptly segregate excess margin securities from firm and customer securities. Excess margin securities are those customer fully paid and excess margin securities that a broker-dealer is not authorized to use as collateral for its own borrowings. This segregation is vital for customer protection, ensuring that these securities are not commingled with the firm's assets and are readily identifiable as belonging to the customer in case of firm insolvency. Question 25. Which of the following best describes the FINRA requirement for a broker-dealer to have a Chief Compliance Officer, CCO? A. All broker-dealers must have a CCO, who must also be the Financial and Operations Principal, FINOP. B. All broker-dealers must have a CCO, but this role is separate from the FINOP. C. Only broker-dealers with more than 10 registered representatives must have a CCO. D. The CCO role is only required if the broker-dealer engages in investment banking activities. Answer: B. All broker-dealers must have a CCO, but this role is separate from the FINOP. All FINRA member broker-dealers are required to designate a Chief Compliance Officer, CCO, who is responsible for administering the firm's compliance program. While the FINOP, Series 27 holder, is responsible for the firm's financial and operational compliance, the CCO has a broader oversight role for the firm's overall compliance with securities laws and regulations. The roles are distinct, with the CCO generally being an executive officer who provides an annual report to the board on the firm's compliance. It's important to recognize these distinct but complementary regulatory roles within a broker-dealer.